Well, hey there, everyone. Happy Tuesday, March 3rd. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of classic Seattle day here. Kind of chilly, but not too chilly. Little wet, but not too wet here in Redmond, Washington. Hope you guys are all doing well wherever you're tuning in from. And thank you so much sincerely for watching my work, for following my content, for engaging through questions and great feedback over the years. I so appreciate it. And it's a pleasure to be hopefully illuminating these markets through shows like this with all of you. Hey, listen, today we're going to talk about just a challengingly volatile day for the major averages. The S&P and the other major averages opening up significantly lower as events in the Middle East have accelerated, as gold and precious metals tanked, as rates spiked higher. And then through the course of the day, that initial reaction was tempered a bit. And I would say there's a message there, right? I mean, a lot of people think, okay, the story is, big downturn in equities. And I don't truly believe that the downturn in equities is over at this point. But I don't think that's the story. It's not the directional implications of what we're learning today and reaction to the news flow. It's the volatility, right? The idea is, in a period of uncertainty, the markets are uncertain as well. I mean, what you can see from the action in major averages, the market's not quite 100% sure what to make of all of this, right? The implications are not particularly clear. The future is generally cloudy. And when that's the story, and it's major headlines hitting, I feel like at least every 24 hours, we got a new string of meaningful headlines that we're digesting. The market's kind of going to overreact in both ways. And so there's going to be some headline that's going to cause the market to spike higher. There's going to be some that, like we saw this morning, causes the market to spike lower. We're all trying to get our head around the long-term implications. I had a great interview, by the way, as we bring up some market action here. Had a great interview earlier today with legendary investor George Noble, who came on the Market Misbehavior podcast. We should have that episode out for you most likely tomorrow morning, but I hope you'll tune into that one. A lot of fascinating comments as always. George is a character. He is an incredibly knowledgeable and experienced investor, and I mean, he was an assistant to Peter Lynch and in his Fidelity Magellan heyday, and went on to run what became the number one mutual fund in the world at one point, the Fidelity Overseas Fund. And he's just got fantastic stories to share, great insights, and a perfect guest to deal with what we're dealing this week, which is a lot of short-term noise. And a lot of his comments were, let's really think about the signal. Let's think about the long-term implications and what we've been seeing, not just in one trading session, but over the course of weeks and months and quarters. That's the time frame where the really good opportunities are. So please keep your eye peeled for that one. It was a really fun interview and some great little anecdotes that only someone like George has the ability and the first person experience to share with all of you. We're going to talk about the market conditions here. We'll look at the heat map. We'll look at a bunch of charts. Actually, I had to stop grabbing charts and just start recording because there's just so many charts to try to review to make sense of what we saw today. So we'll go quickly through the market recap. You've probably been watching things pretty closely, but in case you missed it, major averages down today. Now, honestly, given how brutally bright red the S&P and the NASDAQ were out of the open, despite the fact that non-U.S. markets were off aggressively today, right? I mean, the emerging markets ETF, EEM, was down over 5%. Japan down 5%, Mexico down 5%, even developed Europe like UK, Germany, France, all down over 3% today. So this is a big drawdown, certainly in a lot of places. And again, as the implications of what's happening in the Middle East and just the fact that the scope of the conflict appears to be growing and not ending anytime soon, at least, is causing some instability in some of those markets. The fact that the S&P and the NASDAQ were able to salvage only being down about 1% for the day is truly remarkable. And that shows you how optimistic investors were after that initial drawdown, right? So we closed yesterday around 68.80. We got down to around 67.15 before buyers came in. That was around 10:30. So the first hour of trading was just really bad. And that was the initial reaction as markets opened. Obviously, the futures have been down a lot more before that. But then through the rest of the morning, really until about 2:45 Eastern, market had a nice upward resurgence. So those initial losses were being bought pretty aggressively, causing the averages to get back up to that level. Came off a bit in the last hour or so of trading, but the S&P did get back up to around 68.16. So that's down slightly below 1% for the day. The NASDAQ down about 1% as well. The Dow not too different. Mid caps, small caps all down. The S&P 400 mid cap index, the worst performer, down 1.8%. All of that downward movement caused a huge spike in the VIX. The VIX got as high as 28 today. It did settle down as equities sort of recovered a bit into the afternoon, but finished well above our kind of red flag level of 20. So VIX above 20, VIX spiking up to 28. This is a high volatility environment, and that's what we see today with just the movement, right? I mean, it's not about, a high VIX does not necessarily mean that stocks go down, right? There's no guarantee, although generally that's kind of happened. That's not the relationship, right? Higher VIX means higher volatility. It means higher uncertainty, higher, speculation and open, ideas about what might happen next. Unclear, right? It's cloudy. This is literally the fog of war as represented in market activity. So, buckle up, I would say, this week and most likely the weeks to come until we get some sort of resolution. If we get that with the conflict in the Middle East, expect further volatility as more uncertainty blossoms. Bonds had quite a move. I mean, again, the 10-year yield got up to just about 4.1%, kind of came right back down. And by the end of the day, the 10-year yield wasn't much far off of where we finished on Monday. I mean, out of the U.S. equity open, the story was bonds spiking, dollars spiking, so bonds selling off, stocks selling off, all of that sort of reversed itself going into the afternoon. So the 10-year yield still around 4.05. The long bond yield still around 4.7%. Both of those were much higher earlier in the day, but bonds rallied along with stocks in the afternoon. The TLT ended up being down less than 0.25%. The dollar did remain quite strong through the course of the day, although that initial spike was alleviated, but still the damage was done. So we have a stronger dollar, and as we'll see on the commodities page, that's putting some downside pressure on precious metals for sure. Silver was down over 10% out of the equity open, but in the end, the SLV was down 8.5% for the day. Gold down 4.5% for the day. Now, again, going back to my conversation with George Noble, the reality is, even though gold is having these 3 to 5% daily swings, the chart of gold is still pretty good. I mean, if not remarkably good, right? We're still above key moving averages. The trend is still positive. Our market trend model is still quite supportive. And so the problem is, again, we've come out of a period where volatility has been relatively low for so long. These big volatile swings seem very uncomfortable, which means on big down days, you're going to be tempted to kind of unwind everything. On big up days, you're going to be tempted to feel like a rock star genius if you're on the right side of things. I would encourage you to try to disconnect as much as possible from the day-to-day noise. Focus on how the short-term movements are causing meaningful changes, if at all, to the longer-term charts. That's how you navigate through a period of market instability. When in doubt, zoom out. You take a step out. You look for context. Don't overcommit based on what happens one day, 1 hour, 1 minute. Take a step back, take a big, deep breath, be a little more mindful about it, and think about how the evidence has changed on the longer term timeframes. I hope that's what you can internalize with this particular movement, market action. Crude oil spiking quite higher today, although it came off out of the open. It looks like crude oil futures were just going to, just absolutely roar to new 52-week highs. They did settle down through the course of the day. This is the USO that we're looking at. We can see almost made it to be net negative for the day, which is crazy given the fact that the initial reaction was because of all of the news about most likely disruption to the crude oil supply in varying degrees of or varying level, specific news headlines that came out. But the market generally settling down as the initial fears started to wane. But crude oil still up on the day here. Cryptocurrencies all feeling the pain here, although Bitcoin, which did get down to around 66,500 or so, did rally back up. It's currently trading right around 68,400. That's down slightly from yesterday. Ether prices are lower as Ether has gotten back below 2,000 after spiking above that on Monday's session. But most of the top 10 coins you can see tracked there in the red. All right, the sector breadth was not good. When we look at the S&P sectors, you can see only one, communication services, managed to finish in the green, and not by much. It was 9 pennies higher than it was Monday. So for all intents and purposes, the 11 S&P sectors were basically rotating lower today. So communication services, your top performer, basically flat for the day. Financials essentially flat as well, down less than 0.25%. Real estate down about 0.5%. On the downside, though, the big pain is in the materials sector with gold and silver prices going down. Any mining-related names got dinged pretty good today. So the XLB was down 2.5%. Industrials down 1.9%. There's technology, third from the bottom, down 1.5%. The problem there is you have to remember is, when you look at this table, right, each sector kind of looks like it's even, and we're looking at the number of sectors out of the 11. But you have to remember, technology is about a third of the S&P, so it's like the font should be like 72-point font, and like materials should be like an 8-point font. That would be a little better representation of the relative weights and meanings of those different sectors being up or down. So tech being down at the bottom of the list is going to hurt pretty bad, and that's pretty much what I'm seeing here. All right, looking at the breadth data, the New York Composite Index, which is the main one that we look at, that top line there, about a 3-to-1 ratio. 76% of the New York Composite Index was down today, only 22% higher. We can see on the S&P 500 about the same, right? 73% up to 27% down. It's about a 3-to-1 ratio. And the small cap index, the best breadth, but still pretty bad, about a 2-to-1 ratio. So sector breadth, stock breadth, all fairly negative today. While the S&P and the NASDAQ did recover after those initial losses, this week's actions so far can generally be seen as fairly negative. Now, what we're going to see in a minute is, even with that, though, the S&P has still not broken down. It traded below our line in the sand, but then got back above it into the close. So we'll look at that here in a little bit. Just to finish off here on the market recap portion of the show, the Magnificent Seven and Friends, Microsoft managed to close higher, about 1.33%. Here's Netflix again, continuing that rally after the news on the failed deal with Warner Brothers, up about 0.2%. Meta and Amazon both finishing slightly higher. Tesla down almost 3%. Broadcom and Nvidia, two of the big chip makers, down about 1.5% or so. All right, let's look at the heat map. As a reminder, your questions are awesome. I can't tell you how much I appreciate all the great questions I've received from you guys as we've been doing the show here. Please keep them coming. We'll do a mailbag episode on Friday of this week, and we'd love to feature one of your questions on that episode. Best way to get your questions to us, go to our YouTube channel, drop a comment with your question. We read every question that comes in, and I'll look forward to hearing from you guys. All right, here's what happened on the heat map. And again, the heat map was pretty fluid, right? So different parts of the day, it actually looked a lot worse, first hour of trading as everything opened so weak. But then through the course of the day, things started to improve a bit. But the damage definitely done. I mean, I can't help but notice in the upper left corner, the technology sector I'm drawn to. And I'm drawn to the fact that even though the technology sector was third from the bottom and down, more than the S&P, and certainly dragging the S&P and the NASDAQ lower, and there are plenty of stocks that were down, particularly the semiconductor names. Lam Research looking more and more like a big double top pattern. I did grab that chart to share with you, and other semiconductors like KLAC, AMAT, AMD, all down today. So a lot of red in some key names, and very volatile group. The hard drive names both down pretty good today as well. That's Western Digital and Seagate. But what strikes me in this sector is the fact that there are a bunch of things that were actually up pretty good. Now, Palo Alto Networks, PANW, is still not a great chart. It's undeniably still in a primary downtrend of lower highs and lower lows, but it was up, almost 4% today. IBM, which is bouncing off of a new 3-month low, was up 2.5%. Adobe, which has been down in a primary downtrend. So if you look, what's consistent with a lot of those charts, a lot of the names that were up today in the technology sector are the names that have been beaten down for a while. Names have already given back a lot of those gains. So it's the semiconductors that have remained fairly strong that are pulling back. It's the beaten down technology names, the ones that have already priced in some negativity, starting to rotate higher a bit today. That's not, the complete story, but certainly something to observe. Within the communication services sector, I wanted to note while the sector was one of the better places to be today, it's kind of the old school telecoms, charts like AT&T and Verizon that actually had a good day today. The larger names, kind of the internet names outside of Netflix, got dinged. A lot of red in the consumer discretionary sector, also in consumer staples, which remains in sort of back on its heels. Charts like Philip Morris made new 52-week highs last week and are giving back some of those gains this week. In the industrial sector, big pullback in a lot of names that made new 52-week highs in February. Charts like Caterpillar, which are coming off of a fresh all-time high, pulling back. Charts like Train Tech, ticker TT, which were up, retesting previous all-time highs, pulling back this week. Aerospace defense names, which rallied pretty good yesterday, giving back some of those gains like GE, Howmet, HWM, Raytheon RTX, all pulling back today. Finally, I'd mentioned the choppiness, and again, Newmont Mining is becoming one of the more volatile charts out there. Freeport McMoran, FCX, having some big swings now as the underlying commodities are having significant swings to the upside and the downside. All right, I'm going to leave it there only because I've got a lot of charts to share with you, and I want to make sure I make time with it. Make time for that. And the other thing I need to make time for is some bad news. I hate the fact that part of my role with having an audience of people interested in technical analysis, I have to share when one of the legends passes, and that happened here last month. I just learned about it. The great John Murphy, legend, author of, and I actually couldn't find my copy of Technical Analysis of the Financial Markets. It's the first book I ever read on technical analysis. It's here somewhere. It might have evaporated from just overuse because over the years, it was the first book I read 25 odd years ago, and I kept going back to it. And I've just got this underlined, weathered copy of his book, which is now, has had many editions after. This is his book on intermarket analysis. John was an inspiration. He was, one of the first to go into financial media. He was the first CNBC commentator that really focused on technical analysis. Any of us that have gone on financial television, any financial media, and talked about charts, I think have John partly to thank for the opportunity, right? The fact that he sort of opened that door for many, I think, to be able to go out and in the media and talk about charts and feel some credibility with that. John was an educator primarily. He was thought of as a market practitioner, as a market expert. But I think what I love about John, and the reason why I've modeled a lot of what I've done after things that he's done, is because he was an educator. He saw his role with writing and doing videos and going on TV as educating investors and helping them make better decisions. So what a loss. One of the giants in the industry. So many of us, I feel like, that have had successful careers can thank people like John for setting the stage for that to even happen. So rest in peace, John. We will miss you. And thanks for all you did for so many of us. All right. I tell you what, if John was here today, he would probably want to look at some charts. So best way we can celebrate his memory, one of the greats, is to look at some charts, maybe apply some of John's concepts to what we're doing, shall we? Here's the chart of the S&P 500. As you'll see on the daily chart of the S&P 500, it's not a perfect hammer candle. So I don't know if John would sign off on that, because you've got a bit of an upper shadow, but it definitely is a short-term reversal of some sort, right? Because we opened above this line in the sand, which is right around 6,800. We traded all the way down to almost 6,700 before closing back above that support. So when you have an established support level, we trade below it, but close back above it. I see that as just further validating this level. All we learned today from a technical perspective on this chart is that willing buyers are still coming in and buying moves below that 6,800 level. That's what we saw a number of times here in January and February. Now in early March, we're seeing the same thing. So even though the open felt pretty bad, even though I thought the narrative today was going to be the break of our initial line in the sand, the line in the sand for now is holding. The momentum is holding. Earlier in the day, the RSI was actually below 40, which felt like a pretty meaningful breakdown, but it closed back above 40. So for now, still treading water sideways there for the S&P 500. I just want to check because I grabbed a ton of. Nope, we're good. I think I got all of them. All right. Breadth conditions still good, right? So still 57% of the S&P members are above their 50-day moving average. But we have to remember is back here in mid-January, it was around 72, 73%, which means about 15% of the S&P have broken below their 50-day moving average in the last 6 weeks. That's one way to read that indicator. It's not exactly that, but that's about right. So what that tells you is even though the S&P has been treading water, we're starting to see less and less stocks holding their 50-day, just like the S&P itself is not holding its 50-day. The long-term breadth is still great. So we've still got 63% of stocks above their 200-day moving average, but we're starting to see some breakdowns. This might be an important chart that we've not talked about a ton because it's just been consistently positive, but this breaks below 50%. That's often the sign of more of a meaningful corrective move. We'll also keep an eye on the bullish percent index, which today and this week has now dropped down to just below 55%. We're at 55% of the S&P members with a bullish point and figure chart. That's down from around 67% second week in January. So again, a lot of names within the S&P are getting a sell signal on their point and figure chart. And that speaks to some of the internal weakness that we're starting to observe. It's not bad, right? It's not a bad level yet. It's just a lot less good than it was. And it tells you there's some rotation underneath the hood. Now, if the S&P is closing lower today, how come the Chaikin money flow is making like a new, monthly high here? And the answer is the Chaikin money flow is a volume-based indicator. It looks back at like the last 20 days or last month or so is what I use and most people use as a kind of default setting. And it's basically looking at the daily volume readings, but weighted based on where we close versus the high and the lows for the day. So we gapped lower at the open, but you see how we closed near the highs of today's trading range? Same thing yesterday, same thing last Friday. Lower opens, but higher close, and we close in the upper half of the range. Those 3 days are considered bullish volume according to Chaikin's indicator because it implies accumulation during the day, right? So closing near the highs of the day, even with a gap, implies stronger momentum. So the volume, it looks like we have these big volume bars that are red, which means at lower close, but Chaikin's indicator here considers that bullish volume because it indicates that investors are buying in on weakness during the trading day. So the volume picture, according to that indicator, is still pretty good. Now, the Hindenburg Omen, which is an indicator we follow, and it's a really more of a long-term indicator looking for conditions similar to major market tops going back in history, fired again yesterday on Monday's session because the McClellan oscillator had turned below zero, because we finally had over 2.5% of NYSE listings making a new 52-week high and at least 2.5% making a new 52-week low on the same day. That's happened a bunch of times in the last month. I mean, look at all of these observations where this indicator goes up to 3. That means all 3 of the factors are firing on the same day. And the multiple signals that we've had over a 1-month period imply a confirmed Hindenburg Omen signal. And we had one of those back in November. We talked about looking for a break in the line in the sand. We never really got it. Now we've had another cluster of indicators which suggests, according to this indicator, we are demonstrating similar conditions to previous market tops. It behooves us as well-rounded and knowledgeable investors with good market awareness to be looking for signs of a potential breakdown. Felt like today might be it. It really didn't going into the close. We recovered enough, but the warning signs are there. The red flag very much being waved by the Hindenburg Omen. Here's the VIX on an intraday basis. It spiked all the way up to our big-time danger level, 29 or so. And that level in green comes from the work of Ned Davis. I remember interviewing Tim Hayes years ago, who's the chief strategist at Ned Davis and worked with Ned for a number of years. And they had done some deep analysis into the history of the VIX and looking for VIX conditions around major market corrective periods. And they had found that as long as the VIX remains below 29, usually that doesn't mean a huge correction, just a minor pullback. So it definitely caught my eye as the VIX spiked above that threshold. It did come down to finish today sort of around 23.5, but we are definitely continuing to trend higher. The MOVE index, which is like the VIX index for the bond markets, also trending higher in 2026. So again, I mean, just with the Hindenburg Omen, with the breadth starting to come down, with volatility increasing, with credit spreads widening, all of these are, with the MOVE index going up, all of this is sort of implying we're kind of like standing over the precipice, just kind of looking down into some uncertain but most likely not great path going forward here. We'll see what happens, but I'm seeing a lot of warning signs right about now, to be totally honest with you. Rates look like they were going to accelerate above 4.1%. Let's looking at the 10-year yield, maybe making me think that 4.2%, which is the 200-day moving average, would be a level to keep in mind here through the remainder of this week. But bonds rallied going into the afternoon, just as equities did. And as a result, 10-year yield came down, ended up not too far away from where we were on Monday's close. I don't think we're done yet here. We'll keep an eye on this, but rates popped higher here as just worries about the news overnight out of the Middle East. So crude oil spikes, gold sells off, dollar rallies, rates spike, bonds sell off, stocks sell off. All of those things kind of corrected themselves a bit, though, going into the afternoon. But that's an important chart to watch. All right, here's what happened with the U.S. dollar. The U.S. dollar now this week is spiking high pretty good. We haven't seen an upward spike in the dollar like this in a while. I think you have to go back to like summer of 2025 for the last time we've had this like multi-day spike higher in the U.S. dollar. And it implies obviously some concern, some sense of instability, and some sort of flight to safety. But what you're also noting is crude oil prices, of course, with supply chains threatened, and news headlines sort of implying that sort of thing. Crude oil did spike up pretty good today. So crude oil currently around $75 a barrel. Gold coming down. So the GLD I have in a little bit, but gold kind of pushing down to test $5,000 an ounce again. The long-term chart of gold is still okay, and I have the chart of the GLD to show that. So, right, gold sold off here, but then closed back above the 21-day EMA. So even in the short term, we're not even seeing a breakdown of short-term moving averages just yet. It's just if you look at the chart of the GLD like in December, this is kind of what we have in our mind is a low volatility kind of consistent uptrend. The reality in gold in 2026, if there was a VIX of gold that I looked at, which I if there is one, I don't use it or look at it. But if there is one, I'm sure it would be pretty noisy right about now compared to where it was in like November or December. We're just seeing bigger swings in both directions, right? Big swings higher, big swings lower. So gold is moving more like cryptocurrencies traditionally have, with these big swings to the upside and the downside. But overall, has that changed the long-term trend? I would argue not yet. Speaking of that, semiconductors under pressure this week here, and really last week is when we saw the SMH start to come down. With the pullback that we're observing, I think it's about as clear of a bearish momentum divergence as I can find right now. So late January to late February, higher highs in price, lower peaks in momentum. That's a bearish momentum divergence, implying we're toward the end of this bullish phase. For now, we have traded down to the 50-day moving average. We've had a bunch of tests of the 50-day moving average on semiconductors going all the way back to, really here, summer of last year. And every one of those has eventually recovered with a move back above the 50-day moving average. Is this more of the same, or is this further deterioration? So what we look for, note how we kind of generally held the 50-day in those previous times. That would need to break. Note here how the RSI stayed above 40 during those tactical pullbacks. We sell off further, RSI breaks below 40. That would be one of those things that would tell me this is something more significant. This is something more negative. For now, it's okay. Lam Research is one of many semiconductor names looking a lot like the SMH with that bearish momentum divergence. LRCX pulling back, holding the 50-day moving average into the close today, still holding the February swing low. It wouldn't take much for this chart to look like a big breakdown scenario. Break below the 50-day, break below the February low, which would be around 205. RSI below 40. That would be another thing that would suggest to me, Lam Research is really starting to break down. Lam Research, by the way, what's interesting about semiconductors, they haven't all looked the same, right? Intel usually looks very different than the rest of semiconductors because of the nature of its business. But like NVIDIA, AMD, Broadcom, these charts have been weaker, while other names like KLAC, Lam Research have actually looked pretty strong still. If these struggle, that's like the part of semiconductors that still look good. And if those aren't looking good, yikes. NVIDIA was very curious, given the initial sell-off, if charts like NVIDIA would complete a breakdown. Boy, it didn't. It held its 200-day moving average. We traded right down to the 200-day yesterday and held it. Today, we didn't even touch the 200-day. So from Friday, now Monday and Tuesday, we are holding the 200-day moving average, which means NVIDIA still okay. But NVIDIA below the 200-day, even worse, below 165, which would clear all of this confluence of support. That would be a major downward scenario, I would say. I got some questions from people here this week, why I'm highlighting some of these beaten down names, right? Like ServiceNow is one that I'll share with you, just bouncing above the 21-day EMA. To be clear, right, is this my favorite chart I'm going to share with you today? 100% no. Is this generally the type of chart I like to put in my own portfolio? It is not. Because I'm not big into buying very weak charts. I like to buy charts that have already started to show strength. I like to buy charts that are pulling back within an uptrend. That's kind of my generally favorite thing to do. But in some long-term accounts, I will take a shot at a very beaten down name, thinking more holistically, thinking more long-term, thinking if my runway is long enough, this is a thing that's beaten down a lot. We start to show some initial signs. Maybe I take a small position just to see if it works. That's kind of why I'm highlighting this chart. And I know a number of my viewers, and certainly some of my premium members like to buy reversals, right? Like to buy beaten down charts that are just starting to turn. So it's to help you guys identify some of these charts and think about the technical characteristics that can help you surface these names. Is it a little early to be declaring ServiceNow a recovery chart? I would say absolutely it is. We've made it above the 21-day EMA, which is a good start. Let's see if we can get above the 50-day. The RSI has moved up to around 50. That's a good start. I'd want to see the RSI push above 60, which you have to remember is in a downward trend, the whole range of the RSI moves down. Note how in these rallies, these counter trend rallies, the RSI doesn't get much above 60. That's how it confirms we're still in a bearish trend. RSI above 60, price breaking above the 50-day. Those would be the things that would convince me this is more of a meaningful reversal. I had some questions from premium members over the weekend about global stocks. I just wanted to highlight the chart of Canada, EWC. Now, this is showing a bearish momentum divergence similar to what we saw with the SMH, the semiconductor ETF, and some of the semiconductor stocks like Lam Research, LRCX, a couple charts ago. Canada is showing a bearish momentum divergence. A lot of the other kind of global developed markets like Germany and France and others have a similar kind of configuration, higher highs on weaker momentum. Now, a lot of those broke down big time today. Canada did not break down nearly as much as some of those other markets. And to be honest, it actually ended up closing near the highs of the day. So why does Canada look so much stronger than some of these other markets? It has to do with the configuration of the sectors, right? What sectors dominate those markets, right? When you look at the Canadian benchmark, number one sector is financials. After that, it's probably materials and energy. And I don't know which is 2 or which is 3, but I bet those are the top 3. And so it's basically raw materials and energy, and then banks that are facilitating all of that stuff. That's the bet, right? So Canada is about commodities. If commodities are generally doing well, and if energy is doing well, which is like the story for a lot of the Canadian markets, very energy focused, Canada's going to do pretty well. So so for now, is it the best chart? I mean, it's concerning because of the bearish momentum divergence, but is the trend still very much in play? And is it dramatically outperforming the S&P in 2026? Both of those things are true. Wanted to highlight the chart of Albemarle, yet another chart I will share with you with that bearish momentum divergence. And again, the fact that we're seeing so many of those is just yet another bullet point on the checklist of concerning things Dave is observing right about now in February into March, right? With the Hindenburg Omen, with Brett starting to deteriorate, bearish momentum divergences are a tough one. And these are things that tend to happen kind of going into a major top because those divergences are happening as the price is going higher. Albemarle, I wanted to highlight because we're pulling back a bit. We're making that higher high. We're pulling back. Today, we closed briefly just below the 50-day moving average. So I just want to highlight this right here, right? This level around 156 to 160, that was a swing low here in January. We've had a couple tests of that 160 level in February, and now we're right back to that point. So we've pulled back in the last week, but to a well-established level of support. When we break below that level of support, when we make a new monthly low, following through on that weaker momentum situation, that's when I think a chart turns pretty ugly. But for now, holding in there okay. All right, final chart to share with you, Target. Just want to highlight the fact that it's not all bad today. Target's making a new 3-month high today. Earnings this week. So you've got earnings pretty good. Bounce off the 21-day EMA. We were looking at that as a potential short-term support level before the next leg higher. Strong earnings propelling that name to the upside. I like charts that go up post earnings. The question is going to be, if we're in a situation where the broader equity markets are risk off, do you see willing buyers coming in after today's rally and willing to pay more and more for Target? The bull thesis depends on it. Let's see if the chart will confirm it. Folks, that'll do it for today. Thanks so much for watching my content here today. Thanks for watching the show, Chart This with Dave Keller. Please take a moment, if you don't mind, like the video, share it with a couple hundred of your friends. That would help. If you have a question, anything that came up from the content on the show today, please drop a comment below the video with your question. We'd love to feature that question on Friday's All Mailbag episode. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Have a good night, folks.